Hello, folks. Brandon Chapman with today for another Theo Night video on my off night, Wednesday instead of Monday. But anyway, it's good to be with you as we're talking Fed minutes. Fed minutes have normally produced some big movement in the market. Looked like that was going to move higher today. We saw it faded. So the question is the inflation in the S&P, the idea of a Fed pivot already priced in, and we're down from here? So we'll kind of talk about that, as well as look at another number of companies that may be reversing from high levels or have upcoming earnings, etc. But anyways, we look at the S&P. You'll notice we are fading today. We're down about 0.69%. All of the sectors are lower as we speak, with about 25 minutes to go to the close. Energy is the only thing that's pricing higher today. Now, XLE is moving higher as oil inventories saw a big draw this last week, about 7.1 million barrels. However, it did not exactly move the needle in terms of oil prices. But the physical market that's been relatively bullish and tight, maybe we'll start to see the prices of oil start to reflect that, and maybe some of the movement we're seeing right now in energy is kind of playing into that possibility. Communications, materials, cyclicals were the worst performers so far today. And again, obviously with communications, of course, a big part of that is Meta. A big part of it is Google, right? These companies are down at relatively near-term extremes. As you start to look at the S&P 100, you'll notice there's Eli Lilly, which is obviously a drug stock. We got ConocoPhillips, Exxon, Chevron, pretty much bringing up the next three best performers. So as we look forward, if the market is stalling out here, these might be your best opportunities in the near term. Again, if we start to see that tightness in the physical oil market spill back into the paper market for oil, meaning Ford/CL and energy stocks. And at times you might see some bullish move in energy stocks before you actually see oil move, right? However, as you look at the term structure for oil, meaning what? Is oil in backwardation? The answer is yes. Again, we're seeing falling prices going to the future. There's this implied shortage. But notice how it's flattened a little bit from last week and the week before. Again, there's been diminished outlook. And as we think about the minutes that came out today from the Federal Reserve, and to be honest, I hate the fact that they are so preeminent. I thought these were markets. Why are we so worried about regulators, right? Why are we worried about a monopoly that fixes the price of money? Well, the reality is we don't exactly have a market for interest rates, particularly overnight. And again, their infusion of liquidity and pulling the rug out as they diminish liquidity does have an impact. So before we get to the minutes, let's see how things were affected in the market today. So we bring up, let's go to 1 minute chart. The minutes came out 12 o'clock Mountain Time. We saw a nice little run. Looked like we were tapping out about 42.95. We did take that out and then again. And then we began to see the reversal. And the question is, with 25 minutes, 20 minutes remaining, is this just a flag pattern? And do we roll towards lows at 42.55? But the fact of the matter is, we saw the rally fade. The interpretation was initially bullish, and then the algorithms suddenly reversed themselves, and we started to see the market decline. Not necessarily at session lows, but we're working our way towards the open and intraday lows here at 42.55. So the question is, can we extend lower, or do we just hover here into the close? That might give us a sense of where we might be going in the next couple of days. Some of the takeaways from the minutes today. The fact is the Fed saw that the Fed could tighten more than necessary, right? They might push too far. The policy rate would have to reach a sufficiently restricted level to control inflation and remain there for some time. The idea is that rates may have to remain high for longer in order to cure some of the ills that they help create, obviously. They felt like asset valuations are not quite as elevated as they were previously, right? And they felt like, generally judged the bulk of the effects on the real economy had yet to be felt. So the idea normally is about a 12-month lag between Fed policy changes and the real economy. And of course, February, we started really tighten this, started this tightening cycle. We started to see more quantitative tightening enter in June. So the idea is there will be a lag. And you might look at this and say, boy, it does sound like they might be on hold, right? That they may pause. The reality is what we're seeing right now in terms of the Fed funds futures. And there's a site with the CME that shows some of the probabilities here. So for September, nothing's really changed a whole lot, right? We're seeing maybe a little bit of higher chance of 50 versus 75. So that's a 50 basis point increase. That's a 75 basis point increase. So no real changes there. You look at November, again, look at how things have shifted. Nothing's really changed. Where you're probably seeing the most shift, and it's actually becoming more hawkish. If you look out here, for example, 3.75 to 4, a slight shift out here, 4 to 4.25, a slight shift. Notice we're starting to price in the potential of rate cuts. We are seeing it kind of shift more to the upside. So despite the fact that, hey, there might have been some thought that, there might be close to pivoting next year. I think that comment, again, the idea that they may have to keep rates a little bit higher for longer. But again, there is that thought that maybe they're starting to get there and that eventually, right, as we start to see all these rate increases being priced in and inflation starting to come in, maybe there's that possibility. So again, small shift. We've seen some crazy markets for the Fed funds futures. But as of right now, we're seeing a little bit of a shift today towards expecting rates to be a little bit higher for a little bit longer. And maybe that was kind of the realization that kind of came to as the market reversed intraday. However, initially, the thought that the labor market reflects a stronger economy than the Q2 GDP represented, and the idea there'll be a slight positive revision of Q2 GDP. Not that that really matters. The fact of the matter is when you look at data, the data trend has been relatively poor, with the exception of a lot of lagging stuff. So it's really hard to point to the economy and say things are going well, but the reality is the Fed has never called a recession on time, and they never will. That's not politically favorable, right? And so again, they will err on the side of being, not raising aggressively, but there's a lot of pressure right now. And the fact we're talking about the Fed funds rate only going to, let's say, 4% next year, or 3.5 to 3.75%. We're talking, this is, what period? March. What does it say for June 2023? 3.5% or lowers, kind of the odds on bet. We're not talking about a Fed that's grazing as aggressively as they probably should. And the realities of the lower inflation prints that we got for PPI and CPI are likely more temporary. And and that's why I showed the oil market first. We're only a rally away in the oil markets before things start to change in terms of that outlook regarding inflation. Food prices have not cooled. The only thing that really cooled the the headline inflation numbers is the fact that energy prices have been working lower over the last couple of months. And again, the spark we're seeing today suggests that might be changing in terms of oil. Higher demand for gasoline last week as we saw inventories fall. We're seeing greater demand for oil this week, 7.1 million barrel draw in oil inventories. Again, makes you wonder, right? Backwardation in oil certainly seems to reflect the upside risks right now of the physical market. The question is, when does it start to spill over to the paper market? Looking at today's leadership, looking at the fact this was the only sector that's up, I guess utilities are now turning green, suggests that maybe we're starting to see a slight turn. Now, on the option activity front, there were a couple of stocks today in this sector that are showing. This is a Canadian integrated oil company. Higher today. We've been kind of basing here, support around 30, resistance around 34. If we go to the trade tab in here, we look at the September expiration, the 33 strike here, 15,000 contracts. You'll see a big number over here, but it's less than the open interest. We expect that's closing. We're seeing some buying at that 33, mostly buying at the 33 strike. And we start to see, again, maybe a little bit of a line in the sand. If we start to break through 33, if a lot of that volume spills over to open interest, we could create kind of that gamma squeeze and start to drive the price higher. I'm going to redraw my Fibonacci retracement levels. Certainly a 1/3 retracement gets you here. We break 34. We're probably looking at this thing going to about 37.50. Could we get back to prior highs? Absolutely. It's all a matter of what? It's all a matter of what oil prices do. Okay. But at least we are seeing just slightly out of the money print. Break 33. We could see we could readily see this run 36 to about 37.50 over the next week or so. Rig, of course, this is a offshore oil service company. This has had a nice run. It made back about 50%, actually intraday as high as 61%. That was the 261 level. Makes sense though, right? This was our first leg, our pullback, our second leg. We're seeing a consolidation phase here. Makes sense that if we break out of this kind of symmetrical triangle, could we run to $5 in rig? That's the 423% projection off of our seed wave here. The fact we had such a prolonged kind of third wave, 1, 2, 3, 4, boom, 5, seems like that could be readily a possibility, at least in the near term, to $4. And again, oil has to help this trade a little bit, but we are seeing increased production offshore and that sort of stuff. So as we look at rig, this was a 23 SEP expiration out here, 5,300 contracts at the $4 strike price. Again, we're looking at $4 is right here. We start to take $4 out. Can we see that squeeze come in, hedging, driving the price up further to $5? Again, we'll see. Rig is also historically has been a stock that over the last little while has had higher short interest. We can quickly check it here. So and I got FinViz up. We'll just look at Yahoo. So we'll bring up Rig right here. Rig and Oxy have had higher short interest of late. You notice right here, 10.87%, almost a 4-day short ratio. Again, not only do you get the gamma squeeze by virtue of the option strike price going from out of the money to in the money with relatively short amount of time, about a month out, you also potentially see the squeeze on the shorts that could drive the price to $5. So we get this kind of combination of effects: unusual option activity, high short interest, and the fact it's in the energy space. It needs the energy to start to move higher. It needs oil to move higher. And that will start to see the other dominoes fall that could drive this stock towards 5. And of course, there are numbers of stocks out there that have, this kind of dynamics, but these are the two today that are experiencing some bullish activity that could help fuel this. On the flip side, we're talking about oil and gasoline. We can flip this around and talk clean energy. Clean energy stocks, this is a clean energy ETF. Yeah, it's kind of, I say that kind of tongue-in-cheek clean energy, but what we're seeing is a pretty nice run of late. We hit our lows down here at 16. We made a nice run there in May. We've consolidated. Many of the top holdings in this fund also have high short interest, which is part of this picture of the short squeeze going on. Has the short squeeze played out? On Monday, there was significant option activity, and today we're seeing that materialize again on the same strike price. So coming to the trade tab, and here we're looking at a September expiration. There's over 20,000 contracts on Monday, 18,000 carried over to open interest. Today, we're seeing another 9,000 mostly bought at the 22. We should see this open interest swell, potentially to 25, 26, 27,000 contracts as we're adding more longs. And again, we're not closing it out. We're adding to in this case because we saw the 20,000 contracts being bought on Monday. We talked about it in one of my sessions on Monday. But anyway, we've seen it move down the last 3 days. The 22 strikes here. Certainly looks like we're probably poised to retest the low of the gap day. But as we know, we start to break 22. This may cause further selling as we break the low of the gap day. We close the gap and maybe we retest lows at 18. So those are the potential prospects of a pullback here and the potential opportunity. And the fact of the matter is, you look at the implied volatility 30 days out, you see rising volatility as you move out of the money. This is priced really well for just an out of the money long put vertical, buying the lower vol, selling the higher vol over here. And again, it creates a low cost trade, high reward. Granted, if you're looking at 22 and 19, that is a lottery ticket, right? But it's a cheap lottery ticket nonetheless. Again, benefiting from the skew, diminishing the cost. driving the upside. And you got 30 days to do it, right? To get down this 19, 18 level here. Could very readily be a possibility. I realize we just passed the a bill that may support this industry. The reality, though, is that, look, we've probably priced that in likely, and we're looking at least the option market right now has been pricing in a potential reversal. So we could take a look at that, and if the market starts to turn. So let's circle back to the market for a moment here. In this case, looking at the S&P 500, we'll just use SPY as a proxy here. Friday was a big change for the market, right? We saw a big move here, but this last kind of week, this last gasp going into Friday's high was relatively significant. We saw on the 10th, we saw a lot of selling in the VIX, driving it back to 18. For those who have seen my videos or been in my sessions on TheoTrade, you know, we've been looking and waiting for the VIX to get down here, and incorporated with that is also saying that back month volatility reaches an extreme. And the way you can measure back month against front month volatility is VIX 3M plus VIX ratio. And what happened was on Friday intraday, we didn't quite close, but we came very, very close to the 3-month VIX closing 20% higher than the VIX. So 1.2. So if VIX 3M is 1.2 times VIX, that means it's 20% higher then, right? This is where the market's beginning to price in a very significant potential for volatility in the coming weeks here. And normally when you see these kinds of things, normally you expect to see about a 5 to 10% pullback. Why 5 to 10 versus 20%? You're not going to hedge a 20% pullback, right? You're just going to reallocate. So these are the times, the types of signals you can look for as an indication to hedge. And it just so happened that happened as the VIX was hitting those support levels we've been waiting to see for a number of weeks. You also look at the skew index. I spent the last 2 sessions. In fact, I just did a mastermind yesterday for long-term investing where we talked about how to hedge a long portfolio. We talked about some of these measures as an indication to consider to take profits or hedge risk. 130 is historically high for the skew index. We happened to hit that on Friday as well on the 12th. Okay, or really close to it, right? This is not like, the tolerances here are pretty wide for engineers out there. But the idea being is that we hit 130. What you've seen over the last couple of weeks here, you're seeing hedging activity increased, and we happen to see a high degree of skew coupled with high back month volatility and a low VIX, which generally says, again, we're looking for the potential move here of 5 to 10%. Is it 100% of the time this is right? No, but it does a pretty good job of saying, hey, probably up here, I should probably consider taking some profits. If I've got long options, I'm probably rolling them, or spreads. I might be rolling them if I have an in the money long vertical, for example. These are the points where the air starts to get thin. Could we go to 460? Absolutely we could. But the high skew says the path to here is going to be slow with small up days, and we're building the crash potential. High skew means we're walking up the stairs, but we're falling out the window. The higher this gets, this is more of an indication of that possibility. Just so you know, this is highly anomalous up here. Going back over the few decades, you have data on the skew index, 130, very few times are we above 130. We've just kind of blown that out over the last number of years, since about 2014. Again, I'm not going to just go recency bias and say, okay, I'm going to raise it to 145. 130 is that level, and we reached a market clearing level just in May saying we had upside potential. Now we're saying what? The upside potential is now getting diminished and incremental, and it just opens up that downside chasm that we may fall into. And again, we might see a resumption in the bear market, but the reality is that you're still just anticipating a 5 to 10% pullback. What this does do is the fact we did see such a negative move here in the market. We are in a bear market. I still think we're in a bear market right now. If you did not kind of reallocate back here, it is providing right now, if you want to change your allocation a little bit, and we're looking for volatility to probably go up. And this is where, Don's Ultima strategy is really going to play out potentially very positively with higher volatility. And also we're seeing higher skew benefiting as well. Ultima is something we could look at as to maybe reallocate towards selling premium with higher volatility. Because my guess from here, we're probably looking at the VIX probably rising. How do you take advantage of high volatility? You sell premium, okay? Just if that's not clear how to do that. So let's go back here to the candle trend chart. All right, so that's kind of my thoughts on the S&P. We're probably likely priced in the potential inflation posturing by the Federal Reserve, unless there's some major surprise. And again, I'm not sure they're going to change anything economically for the better. It's only going to deteriorate. Certainly, banks are less capitalized than they were. That was something that was mentioned. And again, Wells Fargo today, for example, they're kind of pulling back on their mortgage department. I think at one point in this cycle, they originated 1 in 3 mortgages, which was massive. And they're going to start to pull back because they've seen a significant decline in origination. We're seeing the housing market cool, and we're only maybe just beginning to see the potential of a default cycle coming to the fore. And again, that's not something the Fed can do a lot about. And right now they're hamstrung because of the inflationary pressures we're seeing, and we're seeing that outlook. Maybe they don't get to 3.5%, but it's going to have to take something ugly to deter them. And again, if it's bullish, they're going to get there. They're probably going to go further. We're going to see something. But in the near term, we are heavily overbought. It would make sense to see a 5 to 10% correction here, right? Get you to 380, 5% gets you around 400. Okay. All right. Talked about clean today. Since we're kind of talking about this, let's talk about hedges. There were hedges that were being put on today in the SPY and in the Qs. If you come down here to the bottom, you look at today's options. Today time and sales rather. Got to wait for this sucker to load. Try to clear that out. Yeah, it takes a bit. You'll notice right here, I mean, there was some stuff being put on here. For example, selling a call, buying a put spread. Okay, that's a premium neutral strategy. That's one way to do it. Here, they're just buying a put spread, buying the 415, selling the 390 for 30 September. This is out in December. So again, some downside kind of hedging activity, capitalizing on the low VIX and higher skew. We come to the Qs here. We'll just scroll down, show you the time and sales here. Couple of stuff put on here. 30 Sep 296 puts, bought one print for 345. 331 put, one print for 24,000 contracts at 1078. So again, we're seeing these hedges being put into place. All right, I've got out the closer in a minute. Let's go over a few things. TLRY. Again, this is one of those stocks that are in that high short interest category, along with CGC. MJ on Monday had significant call activity. If the high short interest gamma squeeze is playing out, these may not necessarily come to fruition. But there have been several trades in TLRY this week. Today's actually there was one on Monday, one on Tuesday, and then today. This one's not quite as big out here in Jan 2024. Buying out of the monies at the 20 strike. Early in the week, we saw over 20,000 AUG 450s. Yesterday, there was 14,000 AUG 450s. 26 August 450s in here. So again, they're doing everything they can to kind of squeeze and push this stock, and it's just not budging. There is that possibility that we do break out. And as you look at the upside implied volatility, pricing in that potential for a squeeze here, it does make it relatively cheap if you want to just cast a line in the water as a very cheap call spread. Buy the 450, sell the 550. Costs you about 10 cents, 11 cents. You got $1 of upside, about 89 cents of return relative to the risk. Very short amounts of time. So if we do break out in the next 9 days to 550, it has a high reward. It's got to move about 60 cents, a little less than 60 cents to move to at break even. So again, it's not a great trade, but it's a lottery ticket that really plays if we do start to see a pop or a squeeze here. CGC as well, 20 September 5 on this one. Kind Come here again, just huge, a lot of buying, a lot of intraday probably trading here too, but the idea is just buying the 5. We've started to break 5. This thing could pop, right? We've seen a nice trend. Again, this is one of my focuses early in the week, but again, these are some areas that are still seeing the activity roll in. CANO today. This is a healthcare company, largely kind of in senior type stuff. The fundamentals of this company are not good. We're at a key level of support. We're seeing a bounce today. We're seeing volume, near-term prospects to around $6.56 in the near term. It has higher short interest as well. 17% of the float shorted, 6 days. So again, this is highly impactful if we start to generate a squeeze. And to help light the fire here, we're looking at the September expiration of the 5. You're seeing kind of spill over here. $5 strike, mostly bought. So again, we start to break 5 like we're doing today and generate some buying. We may see a break to about 650-ish in the near term here. LQD. So if we're talking about the Fed potentially pausing and reversing, TLT could be an amazing trade. Some bullish activity in TLT rolling out rather, the August 118 to a 26 August. So again, we're looking at maybe near term a little pop. Again, it's just a roll, but it is at a debit to extend the time frame. Again, maybe we start to get a little bit of a bounce here in the near term if the market starts to pull back. If the market pulls back, we may see risk spreads widen. Bearish activity in LQD today, looking at an October 110, 105. So again, this is a little bit longer. It's not so immediate, but we are looking at, again, the idea that if the market sells off, corporate bonds should sell. Would it be unreasonable for LQD to be down here 105 by October? No, and the skew is beneficial for that type of trade. Finally, we're going to talk about Foot Locker. Foot Locker's made a nice run. They have earnings on Friday before the market opens. And it was interesting, some trade coming in today with Foot Locker, and specifically for this week. So it's encompassing the earnings. About 2,500 contracts here, buying the 31 and selling the 27. Again, is the kicks trade gone? Meaning people buying Jordan, selling them on eBay. Are we starting to see some diminishment in the high demand for sneakers? Maybe it's a possibility. At least maybe this might be indicating that to some degree with a downside put spread looking at $27. The expected move for this week's $360. Again, that puts you at about what, $29, right? 29. This is the 27. So this is pricing and maybe even a bigger move than the expected move that only gets you about 29. This is saying, hey, we may give the entire pre-earnings run away. Anyway. Well, folks, that's the video for today. We'll catch you back on Monday for another Theo Night video. You have a great one.